Hi there, it's Craig Meatherill from Strategic Wealth. Well, it's coming up to the end of the financial year, and this is my second video looking at reducing your tax and boosting your super. In a previous video, I looked at the benefits of concessional contributions to reduce your tax and boost your super, which included the carry forward rules. And in this video, I'm looking at the benefits of spouse contributions and getting the government co-contribution. Now, let's take a look at spouse contributions to super first. Now, what are they? They are simply voluntary or sometimes called personal or after-tax contributions made to a super fund held in your spouse's name. Now, the benefit of doing this, apart from boosting your spouse's super, is that you can claim a tax offset of up to 18% of the contribution amount, up to a tax offset of $540. Now, the maximum equates to a spouse contribution of $3,000. Now, it's important to know the difference between a tax offset and a tax deduction. A tax deduction reduces your taxable income, whereas a tax offset is a direct reduction in your tax by that amount. So it's quite powerful. Now, in terms of the rules, you must have made an after-tax contribution and you can't have claimed a tax deduction for it. You must be permanently living together, and the total of your spouse's assessable income for the financial year must be less than $40,000, and you get the maximum 18% offset when your spouse earns under $37,000. Now, how to claim is quite easy. When you do your tax return, you simply note in the tax return how much you made in terms of a spouse contribution. Now, let's look at the government co-contribution. This is where the government can put up to $500 into your super if you also contribute to super yourself. Now, the benefit of doing this, apart from topping up your super by a little bit, is that you can receive up to 50 cents for every dollar you pay into super, up to a maximum of $500. Now, in terms of the rules, you must earn less than $56,112. You make an after-tax contribution and you haven't claimed a tax deduction for it. You haven't contributed more than the $110,000 annual cap. And importantly, at least 10% of your total income comes from employment-related activities and running a business. It means if you've got to a point in your life where you're only earning investment-related income, then you're not eligible for the government co-contribution. So let's look at what you can receive. So this table outlines if you put in $1,000 or $500 and examines what you would get based on your income level. It's important to note that you get the maximum 50 cents per dollar if you earn less than $41,112, and the benefit gradually reduces until you get no further benefit from $56,112. Now, claiming is easy. You've simply got to do your tax return. The ATO matches up the data from your super fund, and then they make the appropriate contribution. In terms of how to make a spouse or after-tax contribution, the best thing to do is check with your super fund. Often the easiest way to do this is via BPay. They will let you know the BPay biller codes and reference numbers for use for both the spouse contribution and after-tax contribution. Now, I hope you found that overview of spouse contributions and government co-contributions useful. If you think that might be valuable to you or you have any questions, please reach out and get in touch. And I'll see you next time.